Hey guys, it's Nick, and in this video, I want to talk a little bit about 10-year Treasury notes. They're now above 4%, and I want to talk about what's going on in the news between Warren Buffett, Bill Ackman, and even Elon Musk is kind of getting into the fray of, are Treasuries a good deal to buy or are they not a good deal to buy? So if you haven't seen, Bill Ackman came out and he made his case for why he is short 30-year Treasury bonds. So he's expecting that interest rates on these bonds are going to increase, go higher, maybe 5.5%. He's saying, I don't know how soon that's supposed to happen, but that's what he's betting on. And you also have the news of rating agency Fitch downgrading US government debt from AAA to AA plus, whatever that means. And so Warren Buffett came out and said that he still likes Treasury bills and he's investing $10 billion a week in Treasury bills. And his only decision is, should he do 3 months or should he do 6 months? So he's not worried at all. So who's right? Who's wrong? Well, actually, all three of them are basically in agreement. So Warren Buffett likes Treasury bills, not because he likes Treasuries, but just because he has a lot of cash that he's hoarding and he's waiting to buy some stocks that he considers a good value. But in the meantime, that cash is sitting there. So why not make the best use of it? And that's why he's buying Treasury bills and getting 5.3, 5.4% or something like that. So he does like Treasuries, but he only likes short-term Treasuries. And he has said in the past that long-term bonds are a horrible investment. So this video is a few years back where he talks about it.
The one thing we know is we think that long-term bonds are a terrible investment. Basically, all of our money that is waiting to be placed is in Treasury bills that I think have an average maturity of 4 months or something like that at most. Long-term bonds, they're basically at these rates. It's almost ridiculous when you think about it, because here the Federal Reserve Board is telling you we want 2% a year inflation, and the very long bond is not much more than 3%. And of course, if you're an individual and you pay tax on it, you're going to have some income taxes to pay. And let's say it brings your after-tax return down to 2.5%. So the Federal Reserve is telling you that they're going to do whatever's in their power to make sure that you don't get more than 0.5% a year of inflation-adjusted income. And that seems to me I wouldn't go back to penny stocks, but I think I would stick with productive businesses.
So you see, he's basically in agreement with Bill Ackman, because although he is not shorting 30-year bonds, he's also not buying them either. So he doesn't like them anyway. And so Elon Musk chimed in and said that T-bills are a no-brainer. Now you have to take his statement with the context of who he is and what his investments are. So he's a big shareholder in Tesla. I believe in SpaceX. He owns Twitter or X, whatever you want to call it, outright. And so that's highly illiquid. And all of these are very risky and volatile. So he's making his fortune off of these companies that he's directly involved in. He's not buying other stocks and other companies to try to make a few extra percentage points a year. So with his cash, he's just parking it in T-bills because that's the easiest thing to do with the best yield. And he just sets it and forgets it and focuses on the companies that are really gonna make him a lot of money. Now, as for Bill Ackman, yes, he says he is short the 30-year Treasury bonds, but he's not actually short them. He has puts on them. So he has options on them. So if it doesn't happen or the yields go down, he's not going to lose his shirt. He's just going to lose the premium that he invested in these options. And since most people have a short memory and they don't remember the whole fiasco during the pandemic where he was short a whole bunch of stocks and whatnot, and he said hell is coming, and the stock market fell, and he covered his shorts for $2.6 billion and then reinvested in Hilton hotels, which he said could go to zero. So he's basically a promoter or talker of his book, or at least the opposite of his book kind of thing. So if he's saying that he is short 30-year bonds, I would guess he's been short a while and he's ready to cover, or he has basically already covered, or is just looking to get that little extra bit before he covers and goes long or buys something else. Basically, if Bill Ackman said he's long sunny days, I would immediately grab an umbrella. So let's take a look at the Treasury market and the 10-year note yield, why it's going above 4%, and what this could mean for the stock market as well. So looking at this chart of United States government bonds, you see that this yield curve is inverted, meaning the short-term rates are much higher than the long-term rates. So this is like 3 months, this is 30 years. And the orange line are the rates from 6 months ago, and the green line are the rates from a month ago. So here you see the 10-year note is now at 4.178%, where a month ago it was 3.8, and 6 months ago it was 3.5. So that is about 70 basis points. That is a lot for the 10-year note. While short-term maturities like 6 months are about 5.5%, whereas 6 months ago they were about 4.8%. And this is an interesting chart showing the correlation between the 10-year yield and the S&P 500. The 10-year yield on this axis here is inverted. So the lower you go, the higher the 10-year yield is. So you see the 10-year yield here is increasing. And this side is the S&P 500, and it is not inverted. So as the S&P 500 has been going higher, the 10-year yield has been increasing, whereas most of the time they are very closely correlated. Here they are very uncorrelated. How uncorrelated? Well, this is a new record going back to 1998. So the negative correlation looks like it's about minus 0.8. And so looking at this chart, you see most of the time it is positively correlated. And during times of stress, like the internet bubble popping, it gets very correlated, like almost close to 1. Same thing here during the financial crisis. Same thing here during COVID. So why is the 10-year yield increasing? And are these two going to get back correlated? And what does that mean? Will the S&P drop, or will the 10-year yield drop and therefore get more correlated with the S&P 500? So here is what Bill Ackman thinks on why these U.S. long-term rates have increased and why he thinks they're going to increase more, and why he is short treasuries. And part of it is as being a hedge on long duration stocks. So basically he's short duration. So if he has a bunch of high-tech stocks that aren't making a lot of earnings now but will in the future, those are hurt by higher interest rates. They're helped by lower interest rates. So if interest rates are going to go higher, that is bad for long duration stocks. And so that's part of the reason why he's short treasuries, apparently. And so he's saying he's surprised long-term rates have remained this low in light of structural changes. And he says, I would be very surprised if we don't find ourselves in a world with persistent 3% inflation. He says long-term treasuries look overbought with $32 trillion of debt and large deficits as far as the eye can see, and higher refi rates. Increasing supply of treasuries is assured. When you couple new issuance with QT, it is hard to imagine how the market absorbs such a large increase in supply without materially higher rates. And so he makes a lot of sense here, actually. So here's his thinking. If long-term inflation is 3% instead of 2% and history holds, then we could see the 30-year Treasury yield equal the 3% for inflation plus 0.5% the real rate plus 2% term premium, or 5.5%, and it could happen soon. There are many times in history where the bond market reprices the long end of the curve in a matter of weeks, and this seems like one of those times. And so that is why Ackman is short 30-year bonds, but this is why Berkshire Hathaway is long treasuries, because they have over $120 billion in cash. And when you're getting 5.5% or so on short-term treasuries, that's $6.6 billion a year or $550 million a month. So like Elon said, this is a no-brainer because while he's sitting on this cash looking for deals, this money is inflating away with inflation. So at least he's getting as much as he can back for it. And so that's why he's in treasuries, but he is not in long-term treasury bonds. And apparently he will not be in any of them anytime soon unless the rates get up to some rate that he is really interested in. And why is Buffett holding so much cash? Because maybe his Buffett indicator is showing that stocks are still very expensive according to his indicator. And what's his indicator? It's basically the market cap of the stock market divided by the US GDP. And historically, it's averaged about 1-to-1. In other words, if our GDP is 25 trillion, then the market cap of the stock market should be about 25 trillion. Well, in 2021, we got up over the level of 2. So if our GDP was 25 trillion, the stock market was 50 trillion. Well, it's come down a bit, but it has increased lately, and now it's almost like 1.7 or so. So apparently it is about 70% overpriced compared to the historical average. And so here Zero Hedge says, to summarize, the bond stock relationship regime has never been this extremely decoupled. Ackman is shorting bonds as a hedge on high-flying, long-duration stocks, and Buffett is buying bonds because stocks are too expensive still. So guys, it seems in the end, Warren Buffett and Bill Ackman are on the same page because Warren Buffett is putting his money in treasuries because apparently stocks are a little too expensive right now. That's why he's holding so much cash. So basically his bet is kind of stocks are overvalued and he's waiting for them to become cheaper. Whereas Bill Ackman has probably a bunch of high-flying stocks that he's worried they may be overpriced. And so part of this short on the 30-year bond is kind of a hedge against those positions possibly. So this doesn't mean you should read one headline and see Buffett and say, oh, he's buying treasuries, I need to go buy short-term treasuries. Or see the Ackman headline and say, oh my God, I need to short the TLT or something like that because Ackman's shorting. So guys, don't follow what everybody else is doing just based on some headline or something. Everybody has a different situation. Follow the investments that's best for your situation and don't worry about what other people are doing. Hope you like this one, guys. Thanks for watching.